5. Yeah. All right.
Hi, I'm Dave Staples from Hanover, New Hampshire, and I've got two questions for you. First, I'd like to hear your thoughts on selling securities short and what your experience has been recently and over the course of your career. The second question I'd like to ask is how you go about building a position in a security you've identified. Using USG as a recent example, I believe you bought most of your shares at between $14 and $15 a share. But certainly you must have thought it was a reasonable investment at 18 or 19. Why was 14 and 15 the magic number? And now that it's dropped to around 12, do you continue to build your position? How do you decide what your ultimate position is going to be?
Well, we can't talk about any specific security. So our buying techniques depend very much on the kind of security we're dealing in. Sometimes it's a security that might take many, many months to acquire, and other times you can do it very quickly, and sometimes it may pay to pay up, and other times it doesn't. And the truth is you never know exactly what the right technique is to use as you're doing it, but you just use your best judgment based on past purchases. But we can't discuss any specific one. Short selling, it's an interesting item to study because it's ruined a lot of people. It is the sort of thing that you can go broke doing. Bob Wilson, there's famous stories about him and Resorts International. He didn't go broke doing. In fact, he's done very well subsequently. But being short something where your loss is unlimited is quite different than being long something that you've already paid for. And it's tempting. You see way more stocks that are dramatically overvalued in your career than you will see stocks that are dramatically undervalued. I mean, it's the nature of securities markets to occasionally promote various things to the sky, so that securities will frequently sell for 5 or 10 times what they're worth, and they will very, very seldom sell for 20% or 10% of what they're worth. So therefore, you see these much greater discrepancies between price and value and on the overvaluation side. So you might think it's easier to make money on short selling. And all I can say is it hasn't been for me. I don't think it's been for Charlie. It is a very, very tough business because of the fact that you face unlimited losses and because of the fact that people that have overvalued stocks, very overvalued stocks, are frequently on some scale between promoter and crook. And that's why they get there. And once they're and they also know how to use that very valuation to bootstrap value into the business, because if you have a stock that's selling at 100 that's worth 10, obviously it's to your interest to go out and issue a whole lot of shares. And if you do that, when you get all through, the value can be 50. In fact, there's a lot of chain letter type stock promotions that are sort of based on the implicit assumption that the management will keep doing that. And if they do it once and build it to 50 by issuing a lot of shares at 100 when it's worth 10, now the value is 50, and people say, well, these guys are so good at that, let's pay 200 for it or 300, and then they can do it again and so on. It's not usually quite that clear in their minds, but that's the basic principle underlying a lot of stock promotions. And if you get caught up in one of those that is successful, you can run out of money before the promoter runs out of ideas. In the end, they almost always work. I mean, I would say that of the things that we have felt like shorting over the years, the batting average is very high in terms of eventual. They would work out very well eventually if you held them through. But it is very painful, and it's in my experience, it's a whole lot easier to make money on the long side. I had one situation, actually an arbitrage situation, when I moved to New York in 1954, so it was about June or July of 1954, that involved a surefire type transaction, an arbitrage transaction. It had to work. But there was a technical wrinkle in it, and I was short something. And I felt like for a short period of time, I felt like Fanova was feeling last fall. I mean, it was very unpleasant. You can't make, in my view, you can't make really big money doing it because you can't expose yourself to the loss that would be there if you did do it on a big scale. And Charlie, how about you?
Well, Ben Franklin said if you want to be miserable, during Easter or something like that, he says borrow a lot of money to be repaid at Lent or something to that effect. And similarly, being short something, which keeps going up because somebody is promoting it in a half-crooked way and you keep losing and they call on you for more margin, it just isn't worth it to have that much irritation in your life. It isn't that hard to make money somewhere else with less irritation.
It would never work on a Berkshire scale anyway. I mean, you could never do it for the kind of money that would be necessary to do it with in order to have a real effect on Berkshire's overall value. So it's not something we think about. It's interesting, though. I mean, I've got a copy of the New York Times from the day of the Northern Pacific corner, and that was a case where two opposing each owned over 50% of the Northern Pacific Company, Northern Pacific Railroad. And when two people each own over 50% of something, it's going to be interesting. And Northern Pacific on that day went from 170 to 1,000, and it was selling for cash because you had to actually have the certificates that day rather than the normal settlement date. And on the front page of the New York Times, which incidentally sold for a penny in those days, it's had a little more inflation than Coca-Cola, front page of the New York Times, right next to the story about it, it told about a brewer in Newark, New Jersey, who had gotten a margin call that day because of this, and he jumped into a vat of hot beer and died. And that's really never appealed to me as, the ending of a financial career. And who knows, when they had a corner in Piggly Wiggly, they had a corner in Auburn Motors in the 1920s. I mean, there were corners. That was part of the game back when it was played in a kind of a footloose manner. And it did not pay to be short. Actually, during that period, you might find it interesting. In the current issue of the New Yorker, maybe one issue ago, the one that has the interesting story about Ted Turner, there's also a story about Hetty Green. And Hetty Green was one of the original incorporators of Hathaway Manufacturing, half of our Berkshire Hathaway operation, back in the 1880s. And Hetty Green was just piling up money. She was the richest woman in the, probably maybe in the world, certainly in the United States. Maybe some queen was richer abroad. But Hetty Green just made it by the slow, old-fashioned way. I doubt if Hetty was ever short anything. So as a spiritual descendant of Hetty Green, we're going to stay away from shorts at Berkshire. Okay, Area 6. Hetty, incidentally, in this story, it's a very interesting story. As I read the story, it's almost conclusively clear to me that she forged a will to try and collect some significant money from, I believe, her aunt. And it was a very, very famous trial back in whenever it was, 1860 or 70. And they found against Hetty when it got all through, but she still managed to become the richest woman in the country. Area 6.
Yeah, hi. I'm James Halpern from Dallas, Texas, and I've been a shareholder since 1995, and I feel great about it, so thank you. This question has to do with Berkshire's so-called permanent holdings and whether, when making investment decisions, you somehow mathematically calculate a value to Berkshire's reputation for loyalty to its public investees. Let's say you were confident enough that Pepsi or Procter & Gamble would grow cash flow faster than Coke or Gillette would, and that the replacement value of the stock was less expensive enough to more than make up for the taxes. Would you then sell Coke, for example, to buy Pepsi? And if not, why not? And how do you value this reputation for loyalty aspect in those decisions?
Well, I think that's a very good question. I don't think we would ever, I think it's very unlikely we would come to the conclusion that we were that certain that you mentioned P&G and Pepsi versus the ones, but some major consumer products company would do better than the ones we're in. We might very well decide that some other one is going to do quite well and buy that additionally. As a practical matter, if I'm on the board of the company, or Charlie were to be at representing Berkshire, it's very difficult. I would say it's almost impossible for us to trade in their securities. It creates too many problems. People would think we knew something we didn't, or particularly if we were selling it. We would have people questioning very much whether we had detected something within the company that was not available to the rest of the world. So we really give up an enormous amount of investment mobility when we go on a board, and so I don't even think about doing what you're suggesting, although I might very well if I were just a money manager running the business. We certainly, and we've laid it out in the ground rules in the back of in our owner's manual back in the annual report, we've certainly said in terms of businesses we buy control of that they just aren't for sale, and a fancy price will not tempt us. And we lay out that exception relating to business where we think there's a permanent loss of cash for as far as the eye can see, or businesses where we have labor troubles, which in the day we might have had at the Buffalo News at that one period. But otherwise, simply because we can use the money better someplace else, we're not interested in it. I can't really dig into my psyche and tell you how much of that is because I think that will help us buy businesses in the future if we behave that way, or how much it's just my natural inclination that when I make a deal with somebody and I'm happy with how they behave with me, that I want to stick with them. It's probably both, and I wouldn't want to try and weight the two. I'm happy, with the results of the first, and I'm happy with the way I feel essentially about the second. I just think it's crazy. I know if I owned all of Berkshire myself, I wouldn't dream of trading around businesses with people that have trusted in me and that I like and that have been more than fair with me. I wouldn't dream of trading around businesses so that my estate was 105% of some very large number instead of 100% of some large number. I just would regard that as a crazy way to live. And I don't want the fact I run a public company to cause me to behave in a way that I would be uncomfortable behaving as if we're a private company. But I also feel that you as shareholders are entitled to know that that's an idiosyncrasy of mine, and therefore I lay it out, and I've laid it out for 20 years, as something that you should understand as an investor or before you become an investor. I'm sure it helps us in acquisitions over time, but whether that in any way compensates the opportunity cost that Charlie talks about of making an occasional advantageous disposal, I don't know, and it's something I'll never calculate. Charlie?
Well, I do tend to calculate it at least roughly, and so far I think that the loyalty effect is a plus in our life.
Would you regard that as true, though, in both both marketable securities and owned businesses?
Oh, no, I don't think the loyalty effect in blocks of public companies is nearly as important as it is with the private companies.
You can say it's a mistake for us to be directors of companies because we give up huge amount of flexibility in investment that because we are directors, and there's no question that we do. If you're thinking solely of making money, you do not want to be a director of any company. There's just no question about that. Area 7.
Tom Harrison from Claremore, Oklahoma. Good afternoon, gentlemen, and thanks for a wonderful weekend. This question is for Mr. Buffett. Being somewhat pessimistic by nature, I have a recurrent nightmare of a Wall Street Journal headline proclaiming Buffett kicks bucket.
They may phrase it a little more elegantly than that, but someday the headline will be there.
And of course, Charlie's no spring chicken either. In light of these concerns, could you please go into a little more detail than that presented in your annual report regarding the secession issue? And my apologies for the morbid nature of the question.
No, there's no reason to apologize. I mean, it's a question I ask our managers, incidentally, every couple of years. About every 2 years, I send them a letter and I say, if you die tonight, what will I wish you'd told me tomorrow morning? because I have to make that same decision, and I'm not conversing with them every night, so I want them to put in writing to me once every couple of years what they think about the subject, who they think should succeed them, or whether there's several candidates, or what the strengths and weaknesses are, and I have that information available. And you know, you're entitled to the same sort of answer about succession. It's part of buying into this business, and I can tell you that no one has more of an interest in it than I do, and Charlie has a similar interest because we have a very high percentage of our net worth in the business, plus we've got a lifetime of effort in the business, and we want it to succeed for both, in our cases probably, at least in my case, the ultimate reward to the foundation I have, but also because we just want it, we like what's happened so far, and we want to prove that it's not dependent upon a couple of guys like us, but that it can be institutionalized in effect. And we have, and Charlie and I, we know who will succeed me in what are likely to be two jobs, one marketable securities and one business operation. We want to be very sure that the culture is maintained, and I think it's so strong that I think it'd be very hard to change it. But in addition, the stock ownership situation with me is such that it can, if there were any inclination to change it, it can be prevented from happening. I don't think it would anyway. Now, in terms of who succeeds me, that depends when I die. You know, and there's no sense telling you who it would be today. There'd be no plus to that, and it might not be the same 20 years. Now, I mean, 20 years ago it would have been Charlie, obviously, but it won't be Charlie now because of his age, and it'll be somebody else. But 20 years from now or 15 years from now it might be some third party. But we feel very good about the succession situation. We feel very good about the stability of the organization in terms of the stock ownership situation, because that is insured for a very, very long time to come. We couldn't feel better about the managers we have in place and the culture we have in place. And, you know, the individual will be named. I think I've mentioned, though, that when they open that envelope, although the contents of that envelope are already known to the key people, but when they open that envelope, the first instruction is, you know, take my pulse again. I mean, I'm not... But if I flunk that test, there will be somebody very good in place. Charlie?
The main defense, of course, is to have assets that will do well more or less automatically. And we have a lot of those. And to the extent you improve that further by having very good managers in place and very good individualized systems for bringing new managers into the places, there's a lot of momentum here that would go on very nicely with the present management gone. And now, I don't think our successors are going to be as good as Warren at actually allocating the money.
No, we ran a little test case 10 years ago because for 9 months and 4 days, I took another job at Solomon, and things went fine at Berkshire. We've got, the managers don't need me. We have to allocate capital. We have to make sure they're treated fairly, but we are not making decisions around the place except in the allocation of capital, and that will be important. But some of that is semi-automatic, and others, you know, it does require, you know, some imagination sometime or something of the sort. But for 9 months and 4 days in 1991, you know, Solomon was primarily on my mind, and Berkshire wasn't, and everything went on just as before. And we are far, far, far stronger now than we were 10 years ago. So I'm very comfortable with 99% of my estate being in Berkshire shares, and I think it's an intelligent holding eventually for the foundation, and knowing that, you know, I won't be around at some point before the foundation gets it. Okay, area 8.
Hello, Mr. Buffett, Mr. Munger. My name is Matt Honor. I'm from Tucson, Arizona. It's a tremendous pleasure to be here today. This question probably falls into Charlie Munger's realm of oddball investment activities. But considering Berkshire's previous experience in silver, what are your thoughts on the silver market today? How do you analyze this market? Have you determined an equilibrium price for silver? And if so, would you share that price or explain to us how you determine it?
The short answer is we don't want to talk about silver.
Yeah, we're not going to comment on it, on oil or the prices of anything in terms of making any forecasts about it. The equilibrium price, though, I can tell you, is whatever it's selling for today. But there will be a different equilibrium price a year from now or 5 years from now, but we can't tell you what it'll be. Area 1.
Hello, Mr. Buffett, Mr. Munger. My name's Bob Odom from Seattle, Washington. Considering the political climate and what seems to be a more regulated environment than not in the electric utilities market, and politicians that seem to be passing their constituents rather than the common sense of price and quantity, is it not a risky venture to participate in these markets more than what has already been done with Mid-American, considering that even with a possible repeal of the PUCA laws, that they may be reinstated some years later with the addition or subtraction of any other legislation that a politician may dream up, and then put the investment at risk?
Charlie, you're a resident of California.
Well, the production of electricity, of course, is an enormous business, and it's not going away. And the thought that there might be something additional that we might do in that field is not at all inconceivable. It's a very fundamental business. Now, you are certainly right in that we have an unholy mess in California in terms of electricity. And again, it reflects, I would say, a fundamental flaw in the education system of the country, that as many smart people of all kinds, utility executives, governors, legislators, journalistic leaders, they had difficulty recognizing that the most important thing with a power system is to have a surplus of capacity. Is that a very difficult concept? Everybody understands that if you're building a bridge, you don't want a bridge that will handle exactly 20,000 pounds and no more. You want a bridge that will handle a lot more than the maximum likely load. And that margin of safety is just enormously important in bridge building. Well, a power system is a similar thing. Now, why do all these intelligent people, ignore the single most obvious and important factor and just screw it up to a fairly well? So I'm giving you a response, which is, of course, another question. As my old professor used to say, let me know what your problem is, and I'll try and make it more difficult for you.
Well, to me, the interesting thing is that you had a system. I mean, Charlie's obviously right in that you've got about three goals in terms of, from a societal standpoint, you've got perhaps three goals in what you would like your electric utility business to be. One is you would like it to be reasonably efficiently operated. Secondly, since it does tend to have, in many situations, monopoly characteristics, you would want something that produced a fair return, but not a great return for capital, but enough to attract capital. And then third, you'd want this margin of safety, this ample supply. Now, when you've got a long lead time to creation of supply, which is the nature of putting on generation capacity, you have to have a system that rewards people for fulfilling that obligation to have extra capacity around. A regulated system does that. If you give people a return on the capital employed if they keep a little too much capital employed so that they have this margin of safety on generation and they get paid for it, they stay ahead of the curve. They always have 15 or 20% more generating capacity than needed. And one of the disadvantages of that regulation and the monopoly nature is that it doesn't have the spur to efficiency. They try to build it in various ways, but it's difficult to have a spur to great efficiency if somebody can get a return on any capital they spend. So utility regulators have always been worried about somebody just building any damn thing and getting whatever the state allowed return is. But I would say that the problems that would arise from, say, a little bit of sloppy management are nothing compared to the problems that arise from inadequate generation. So here you had in California, in my view as an outsider, you had a situation under regulation where the utilities had the incentive to have a little extra generating capacity because they got allowed to earn a decent return on it, a return that would attract capital. Then you had, I think, the forced sell-off of half of their generating capacity or something like that, and they sold it at multiples of book value to a bunch of people who are now just generators who are deregulated. They don't have an interest in too much supply. They've got an interest in having too little supply. So you've totally changed the equation because the fellow that now has the deregulated asset for which he paid 3 times book now has to earn a return on a 3 times book what the fellow was formerly earning under the regulated environment at 1 times book. And so he is not going to build extra generating capacity. All that does is it brings down the price of electricity. He hopes things are tight. So you've created, in my view, a situation where the interests of the companies in the business have diverged in a significant way from the interests of society. And it just doesn't make any sense to me. And I really think that the old system was made more societal sense. Let people earn a good return, not a great return, but a return that attracts capital on an investment that has built into it the incentives to keep ahead of the game on capacity, because you can't fine-tune it that carefully, and you do have this long lead time. So now what you do with the scrambled eggs now, is something. And with all the political forces back and forth, I think that you better have a system that encourages building extra capacity, because you don't know how much rainfall there will be in the Pacific Northwest, and therefore how much hydro will be available, and you don't know what natural gas prices will do, and therefore, whether it's advantageous for a gas-fired turbine to be operating. And the old system really strikes me as somewhat better than this semi-deregulated environment that we've more or less stumbled into. But Charlie, what do you think on that?
Of course, even the old system got in some troubles in that since everybody had the NIMBY syndrome, not in my backyard, everybody wanted any new power plant to be any place not near me. And if everybody feels that way, and if the political system means that the obstructionists are always going to rule, which is true in some places in terms of zoning and other matters, you get in deep trouble. If you let the unreasonable, self-centered people make all the decisions of that kind, you may well get so you just run out of power. That was a mistake. And we may make that mistake with oil refineries. We haven't had many new big oil refineries in the last period. So you may get to do this all over again.
All of that being said, there will be need for more generation capacity. I mean, the electric utility industry will grow. It will need lots of capital, and there should be ways to participate in that where we get reasonable returns on capital. We would not expect to get great returns on capital, but we would be happy to do that. We generate a lot of capital, and we would be comfortable in that business. We would not feel the risks were undue as long as we didn't go around paying incredible prices for for somebody else's capacity and then have people get very upset at what that meant in terms of their electric rates. You can't go out and, if you've got a utility plant in this country that was put in place at X, and then you go out and encourage entrepreneurs to buy in at 3X, you cannot expect utility price or electricity prices to fall. And that was, in my view, a very basic mistake. I may not understand it fully. Area 2.
Good afternoon. My name is Pavel Began. I'm from Minsk, Belarus, and I have 2 questions. And before I'll have questions for you, I'd like to say thank you for recommending to read Intelligent Investor. It's a terrific book, and it reshaped me tremendously, literally overnight. So I'd like to thank you for that. And now the question. Say I'm an owner of the business, and the business has a durable competitive advantage and superior business model, and is run by able people. And then, I start noticing that basically management starts doing things which are far from intelligent. So what should I do as an owner, as an investor? Should I try to tell them how they should run the business, or should I just sit back and do nothing? Because superior business model should overcome poor management. That's the first question. And the second question is how important is nominal experience in the business of investing? And by saying nominal, I mean the number of the actual time you've been in the business, as opposed to real experience that also includes experience you acquire from, say, Ben Graham or you or Peter Lynch when you read books. So those are the questions.
On your first question, did you assume that you had control of the business, or you just owned a marketable security?
Yes, if I own, say, 20% of marketable securities.
Well, the situation you described is not hypothetical in the first case. And I would say that the history that Charlie and I have had of persuading decent, intelligent people who we thought were doing unintelligent things to change their course of action has been poor. Would you agree with that, Charlie?
Worse than poor.
Yeah. So I would say that if you really think you're in with people that have got a good business but that are going to keep doing dumb things with your money, you'll probably do better to get out and get in with people who've got a good business and you think they're going to do sensible things with it. I mean, you've got that option. Now, you also have the option of trying to persuade them to change their mind, but it's just very, very difficult. I mean, it is, that's been something we've faced for 50 years. And initially, we faced it from a position where nobody even knew who the hell we were or anything of the sort. But we've acquired a certain stature over time, perhaps, in talking on the subject, and we've written on the subject, and we still don't get very far. I mean, when people want to do something, they want to do something. And they didn't rise to become the CEO of a company to have some shareholder tell them that their most recent idea is dumb. I mean, that is just not the type that gets to the top. So I would say that as a matter of investment technique, and maybe as a matter of avoiding stress in your life and all of that sort of thing, and dealing with smaller quantities of stock so it's easier to sell and buy and all that sort of thing, I would say that it's better to be in with a management you're simpatico with than simply to be in a great business with a management that's bent on doing things that don't make much sense to you. Charlie?
Well, I certainly agree with that.
Second question, I gather, is sort of how much does our actual business experience versus book experience help us, or is it?
Well, I'd say, if you look at a person who has just like 2 years of being in the business of investing and versus a person who has been for 10 years in the business of investing, and say the person who has been for 2 years, has read a lot about, Ben Graham's techniques and your techniques and say Peter Lynch techniques. So would you say that the person who has only 2 years of experience may do much better than the second person?
Well, if everything else is equal, I mean, everything else is equal, except the amount of experience you had. I think the experience is probably useful. But but it isn't going to be equal. And I think it's way more important what you've thought about for 2 years than what you've practiced for 10 years. So if there's a divergence in techniques applied, I would rather be with the one that I'm philosophically in sync with. If I'm philosophically in sync with both, and one's had 10 years of experience, the chances are they will know a little bit more about more businesses if they've been around for 10 years looking at them than if they've been around for 2 years. But the biggest thing is that basically they've got their heads screwed on right in the first place in terms of how they value businesses and how they look at stocks, as whether they look at them as pieces of businesses or whether they look at them as little things that move around and that you can tell a lot by looking at charts or listening to strategists on or something of the sort. Charlie and I have learned a lot about a lot of businesses over 40 or 50 years. But I would say that in terms of the new things that would come to us, at the end of the second year, we were probably about as good judges of them as we would be today. But I think there's a little plus to having seen more in terms of human behavior and that sort of thing than knowing about the specifics of a given business model. Charlie?
Yeah, I think that I've watched Warren for a long time now, and I would say he's actually getting better as he gets older. Not at golf or many other activities, but
stay with generalities.
As an investor, he's better. Which I think is remarkable. It shows the scale of experience matters.
Yeah, it helps somewhat to have seen a lot of business situations. I mean, Charlie talks about models, and you construct your models as you go along based on observation. And your models will, if you're paying attention, your models will be somewhat better the more years you spent really observing and not just trying to make everything fit into what you saw the first few years. Area 3.
Hi, my name is Richard Marble from Washington, D.C., and my question has to do with the intrinsic value of Berkshire Hathaway. You've stated several times that you would prefer the stock to be neither overvalued nor undervalued, so that the time people spend owning the security represents a gain from what the security did, the results during that period of time. However, it's a very difficult security to value because of the disparate pieces. And as we saw last year, when you provide a little bit of guidance, in last year's annual report, you said that when the stock price hit $45,000 a share, you considered buying, but thought it was unfair until the annual report came out, so everyone had the same information. And while I also realize that you don't feel there is a particular quote-unquote correct number, would you ever consider giving any guidance in this direction?
Yeah, the answer is we really wouldn't. I mean, to the extent that we were going to repurchase shares, you could certainly interpret that as indicating that we thought it was attractive from the standpoint of remaining shareholders to do so, and we certainly wouldn't be paying over intrinsic value, at least in our judgment, and benefiting the exiting shareholders to the disadvantage of the continuing shareholders. So you might draw that conclusion at that point. But other than that, we would prefer Berkshire shares to fluctuate far less than they do, because we would like ideally we would like the experience of every investor during the time they held the shares to be exactly proportionate to the progress or lack thereof of the business. And I think we've come over the years reasonably close to that compared to most companies, but the nature of markets is such that reasonably close is probably as good as it's going to get. We don't know the exact intrinsic value of Berkshire, obviously, and if you looked at the figures, if we'd written down secret figures ever since 1965, some of them would look silly now in terms of what has actually transpired. But we try to give you, I think Berkshire is easier to value than most businesses actually, because we give you all the information that at least is important to us in valuing it. And then the biggest judgment you have to make is how well capital will be deployed in the future. Because it's relatively easy to figure out the present value of most of our businesses. But the question becomes, what do we do with the money as it comes in? And that will have a huge impact on the value 10 years from now. And that will depend a lot on the environment in which we operate over the next 10 years. There'll be a lot of luck in it. I think there's a reasonable chance of good luck, but who knows? It would be a mistake for us to do anything, I mean a big mistake, to ever recommend buying or selling the stock. I mean, how would you tell everybody to do it at once? You would negate your own advice. You're certainly not going to tell one person, to the advantage or the disadvantage of somebody else. So there's really no way for us to ever talk about whether we think the stock, whether we think it's a buy or a sale, except to the extent, like I say, on repurchases, where there's obviously an implicit judgment being given the shareholders. Charlie?
Yeah. I rather like the way it's worked out. If you average out the period that we've been through, we've come within hailing distance of the objective of having our stock track its intrinsic value. It gets a little ahead sometimes and a little behind other times, but averaged out, it's worked pretty well.
Area 4.
Good afternoon. My name is Martin O'Leary, and I'm from Houston, Texas. My question to you is this. In your annual report this year, in the letter to the shareholders, you indicated that it was 50 years ago that you met Benjamin Graham and that he had a major impact in your life, especially in your investment success. Moreover, you've stated in the past that The Intelligent Investor is by far the greatest book ever written on investing. One of the central tenets in the book was that if you bought a group of stocks, say 10 or 20, that traded at 2/3 or less than net current assets, that you would be assured of a margin of safety coupled with a satisfactory rate of return. Today, if you were to find 10 or 20 stocks that traded at 2/3 of net current assets, would you be inclined to purchase those stocks for your own personal portfolio, not for Berkshire Hathaway? And the second question, since I've mentioned the book, I was wondering which books that you and Mr. Munger have been reading lately and would recommend. Thank you.
Yeah, in respect to your first question, you could probably, if you found a group like that, and you won't, I don't think, you'd probably do all right buying the group. But not because the businesses themselves worked out that well over time, but because there would probably be a reasonable amount of corporate activity in a group like that, either in terms of the management's taking them private or takeovers or that sort of thing. But those sub-working capital stocks are just almost impossible to find now. And if you got into a market where a lot of them existed, you'd probably find wonderful businesses selling a lot cheaper too. And our inclination would be to go with a cheap, wonderful business. I don't think you'll get in a high market or something close to it. I don't think you'll get a lot of sub-working capital stocks anymore. There's just too much money around to promote deals before they really get to that point. But that was a technique. It was 50 years ago. And is Walter Schloss here still? Walter, are you here? Stand up if you're here. I met Walter 50 years ago when I met Ben Graham. And I know Walter's came out this year, but he already knows everything I've been talking about, so he may have left. Walter actually has practiced in securities much closer to the original. He's run a partnership now for 46 years, I guess it is. And he's done it much more with the type of stocks that Ben was talking about in those days. And he has a record that is absolutely sensational. That is far better than people who get promoted and go on television shows and do all of that sort of thing. And he's done it in what I tend to call cigar butt companies. You know, you get one free puff, and that's about it, but they don't cost anything. And that was the sub-working capital type situations. Walter's had to extend that somewhat, but it's been a great record over a considerable, 46 years, a very considerable period of time. So I think if you found that kind of a group and did it as a group operation, and Ben always emphasized a group operation, because when you're dealing with lousy companies, but you expect a certain number to be taken over and all that, you better have a group of them. Whereas if you deal with wonderful companies, you only need a couple. But I think if you see that period again, we'll be very active, but it won't be in those kind of securities. Charlie?
Yeah, and there's another change. In the old days, if the business stopped working, you could take the working capital and stick it in the shareholders' pockets. And nowadays, as you can tell from all the restructuring charges, when things really go to hell in a bucket, somebody else owns a lot of the working capital. The whole culture has changed. If you have a little business in France and you get tired of it, as Marks and Spencer has, the French say, "What the hell do you mean trying to take your capital back from France? They're French workers in this business." And they don't care about, they don't say, "It's your working capital, take it back when the business no longer works for you." They say, "It's our working capital." The whole culture has changed on that one. Not completely, but a lot from Ben Graham's day. There are a lot of reasons why the investment idiosyncrasies of one era don't translate that perfectly into another.
That list that was published, I forget whether it was published in the 1951 edition of Security Analysis or the 49 edition of Intelligent Investor, but there were a list of companies there. There was Sacco Lowell, there was Marshall Wells, there was Cleveland Worsted Mills, there was Foster Wheeler, and all those companies were sub-working capital companies selling at 3 or 4 times earnings. And there was if you bought a group of stocks like that, you were going to do well. But you certainly don't see that in companies with any size today. And I've seen a few lists of tech companies selling below cash, but they're determined to use that cash, and it may not be there in a year or two. It was a different breed of animal to some extent in Ben's list at that time. Did you ask a second question? Or?
Books you've read.
Oh, books I've read. Well, tell them what books you've read, Charlie.
Well, I mentioned that one book, Genome. I have a hell of a time putting the accent on the first syllable. But that is a marvelous book. And some shareholders send me a book that not many of you will like by Herb Simon, I think, Models of My Life. And it's a very interesting book for a certain academic type. But that Genome, which is the history of a species in 23 chapters, and it's a perfectly amazing book and very interesting.
I may have recommended it before, but if you haven't read Personal History by Katharine Graham, I think you'd find that it's a fascinating story, and more amazing yet, it's an honest story. If I ever write my autobiography, I'm going to look like Arnold Schwarzenegger, but she is compulsively honest about what's happened, and it's really quite a saga.
It is a good book. Yeah. That Janet Lowe book about me, I find has had a very interesting subchapter, so to speak, in its distribution. I notice a considerable number of people buying that book and sending one copy to each descendant. They believe that if they just do that, the descendants will behave more like the parents. It'll be interesting to see if that works. If it does, it's going to outsell the Bible.
Hold your breath, fella. Area 5.
Good afternoon. I'm Laura Rittenhouse from New York City. And I want to say it's a great pleasure to be here. You talked earlier about companies that monetize greed and it's great to be with people and with leaders who monetize values. A couple of years ago, you spoke very passionately about campaign finance reform, and I wondered if you could comment on your views of this given recent developments related to another question in Washington. What's your expectation for the passage of the repeal of PUCA? I know there was some recent activity in the Senate subcommittee. And lastly, a question for Charlie. How would you or do you apply the principles of intrinsic investing to real estate?
Okay, in respect to PUCA, it's hard for me to, I have no great record of handicapping legislative action, but I would say that the awareness of the public of problems in the electric utility industry under current circumstances, has mushroomed. I mean, it ballooned, and so I think it's likely that Congress is more receptive to the idea that they need to do something that ensures that the power supply is adequate. And I think that there's probably a number of them that would think that PUCA is a barrier to capital entering the industry from a lot of sources where capital is available, and that it's going to take capital to solve this problem. Now, they don't have to solve it by letting Berkshire do more things, but it's not a crazy approach to say that if Berkshire has billions of dollars to invest, that it might be a net plus for the availability of electricity down the road. So I think that certainly the chances of repeal or major change are far higher now than they were a couple of years ago. I mean, politicians do not like to face major brownouts. I mean, they can try and blame it on someone else, and they may well be accurate in blaming it on someone else, but the public is going to at least partially blame political leaders if this country runs out of electricity, because it hasn't run out of the ability to build generators. We could create all the generators we needed to have plenty of electricity, and we could create the transmission lines and all of that, but you do need a flow of capital to the industry, and PUCA restricts that flow to quite a degree, I would say. Campaign finance reform, you've read about it as much as I have. I happen to admire enormously what McCain and Feingold have done. I don't think it's a panacea. I mean, money is going to find its way into trying to buy political influence one way or another. But the present situation, in my view, has gotten totally out of control, and incidentally totally out of sync with what the American Congress even, as well as the public, intended, because in 1907, Congress said, and it's never been changed, that corporations shall not contribute money to federal elections. And in 1947, they said the same thing about labor unions, and then they enacted campaign legislation in the early 70s, which, when later interpreted by the Federal Election Commissions, enabled corporations and unions to do on an unlimited scale what Congress had said they shouldn't do at all. And politicians did not really understand the potential in that initially. I remember the first guy that called me, Senate candidate, called me for a soft money contribution in probably in 1985 or so, and he was kind of embarrassed about it and sort of danced around the subject of how this money was going to find its way into his campaign and everything. And he was asking me for an amount of money that was illegal under the law, except if I did it via soft money. And that has developed to the point where I have literally had people where I have firsthand knowledge of requesting $1 million contributions or larger, which would never be reported, would never be required to be reported, and I regard that as a perversion of the system. But I think we're going to get some significant improvement. I think it was only possible because of the credibility that McCain built up with the public and the fact that he just wouldn't let go of this issue. So but I'm not hopeful about it changing the whole course of American democracy or anything of the sort. But I am hopeful that the system of government where access is sold to the highest bidder and where the bidding starts at a higher level by a material amount in every election cycle will at least be checked for a while. Charlie, she had a question for you.
Well, my trouble with campaign finance reform is that I fear career politicians just staying on and on just about as much as I fear special interests protecting themselves with money. And I never know exactly how the reform is going to work. When I came to California, we had a sort of a semi-corrupt part-time legislature dominated by racetracks and saloons and liquor distributors and so on. And people went up and entertained the legislators with prostitutes and what have you. And I really sort of prefer that government in retrospect to the full-time legislators I have now. So I just am more skeptical about my ability to predict which reform I'm going to like the results of and which I would like to trade back in for my former evils.
Laura, you had one more, did you? Was it for Charlie?
It was a question about the principles of intrinsic value investing applied to real estate.
Yeah.
Oh, that period of my life involved the remote past. And I much prefer business investment to real estate investment.
Okay, it's 3:30. We're going to have a directors meeting here. We do that once a year following this meeting. And so I'll ask the directors to stick around, and I want to thank you all for coming, and I hope you come back next year. Thanks.